down here to that decision less than half an hour from now. And the dot plot especially, is the market is very likely to be paying attention to whether or not cuts are going to materialize in a more material way this year than was expected even just a few months ago.
Just to set the baseline here, watching the markets before we get into our special coverage, we're going to kick things to New York in just 1 minute with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. The S&P 500, Kaylee, up 24 points. Not a huge rally, but holding positive today. The 10-year yielding 4.31%.
Yeah, so we'll see how the market actually moves off of this. Keeping in mind, as you quote, where the 10-year yield is right now, that has come down substantially in the last several weeks. And an argument that this administration had made that you don't need the Fed to cut rates to bring rates down and mortgage rates along with it, that other policy could do that job. And maybe we've seen a little bit of that materialize.
That is the message from Scott Bessent, that's for sure. We're bringing the 10-year lower, doing the work for the Fed. With Kaylee Lyons, I'm Joe Matthew. We'll meet you back here 5 p.m. Eastern Time on the late edition of Balance of Power. Special edition of Bloomberg Surveillance. The Fed Decides is on the way next, right here on Bloomberg TV and radio.
The world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays at 9 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance. The Fed Decides.
Live on Bloomberg TV and radio, counting down to another Fed rate decision and Chairman Powell news conference. That decision 27 minutes away. Alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. This Federal Reserve says they don't assume, speculate or guess. A little bit later, will they do just that?
With their projections for how they see inflation and growth going forward, a question of how much they will reflect what we hear across Wall Street, which is firms collectively downgrading their expectations for growth and upgrading their expectations for inflation. Do we get a similar tone from the Federal Reserve?
TK, this is a three-part act, a news conference at 2:30 Eastern Time. Before we get there, a non-decision in the minds of many. But those forecasts will be keenly watched.
The forecasts will be really interesting, and I'd sum together inflation and real GDP. I like what Ernie Tedeschi and Martha Gimbel say at the Yale Budget Lab. Quote, things are getting weird. That's what this Fed meeting is about.
Let's talk about that weirdness. Downside risk to growth, upside risk to inflation. Are they worried about one or the other, or both?
And can they really have a Fed put on markets at a time where potentially you have this stagflationary light type of mix? We've been talking about, is the Fed put in action? Is the Trump put in action? Is the Fed put dead? And I ask that in the way that the market has traditionally known it, where they can rescue markets by signaling a more dovish stance. Does that have the same ramifications for a market that is pairing off with both growth risks as well as inflation risks?
Let's check out this market. Equities right now in the S&P 500 just a touch firmer going into this decision at 2 p.m. Eastern Time. We're higher by 0.5%. And this bond market just can't get away from 430. Will that change in the next few hours? Your 10-year, 431.18.
And I do think that the 10-year might be the most interesting one to watch, especially with discussions around quantitative tightening. Well, coming up shortly, Mr. Exceptionalism, or the U.S. not being so exceptional himself, J.P. Morgan's Bob Michael, Kathy Jones of Charles Schwab, and Bank of America's Aditya Bahave. They will be taking us up to that Fed rate decision at 2 p.m. Eastern. Then immediate reaction from Jim Bianco of Bianco Research, along with Diane Swank of KPMG and Deutsche Bank's Matt Lazzetti. And finally, after we get that press conference from Chair Powell, we'll be hearing from former New York Fed President Bill Dudley, as well as Amanda Lynham of BlackRock, to understand what does dovish mean at a time where there are very different risks that are kind of contradicting each other.
You mentioned Matt Lazzetti of Deutsche Bank cutting his outlook for growth in the last 24 hours and joining a very, very long list of economists who have done just that in the past week. JP Morgan, Morgan Stanley, Goldman Sachs, the list goes on and on.
If the Fed doesn't reflect that downgrade to the growth outlook that we also heard from the OECD, what does that mean in terms of just how much they are really reflecting the growth concerns? And does it actually suggest that they're somewhat more hawkish?
Business. Joining us now to discuss, I'm pleased to say, we can kick off this afternoon's programme with Bob Michael of JP Morgan Asset Management. Bob, good afternoon to you, sir. It's good to see you.
Good to be here.
Let's just start with broad-based expectations for this one. What are you looking for?
What an extraordinary Fed meeting. This is one that in 2031 you're going to want to play the tape of and listen to what they talked about. Think about it. They've guided the economy to the perfect mythical soft landing. While they should be tinkering, they find themselves in the middle of an escalating trade war. That's the situation they've got to deal with. I wouldn't want to be in that room with them. I think you're right. We're going to see the outcome in the dot plot. They're going to acknowledge that stagflation is a real possibility. Growth will be dialed down a bit. Inflation will be dialed up a bit. Let's watch where they put unemployment, because that will tell us how they think businesses are going to respond. We think that ticks up a couple tenths.
We were talking about the Fed put and this question about how much the Fed will be inclined to rescue this market from growth concerns. What does that even look like at a time where it's unclear what they could say that could really prop up both growth and dampen rising inflation expectations?
Well, they're going to do their best to be non-committal, because while they've seen some tariff policy out there, they haven't seen all of it. So they've got to keep their powder dry, so to speak. I think the one thing they're looking at is the level of unemployment. That's going to tell them how businesses are responding to the tariffs that are already in place and how they're thinking about the tariffs that could be coming down the road. I think if they start to see unemployment tick up over 4.5%, they're going to have little choice but to come in and start cutting rates.
We don't do charts for the Fed decides, but I 100% agree with you. If I go back to 1991-92, if I go back to 2002, if we go back to what you enjoyed at JP Morgan in 2007, when the unemployment rate moves, it really moves. Is that where we are right now?
I hope we're not there yet. I hope that businesses are being patient. They're going to wait to see what the actual policy looks like. Right now, it's tariffs on, tariffs off. It's difficult to plan, but if they start to worry and they start to pull back hiring, then I think that becomes a big problem.
Just what is the offset? And you alluded to this. You might get a sign of how the Fed thinks about this in the forecasts. How do you think the Fed will be navigating some of these changes to policy that we've seen over the past few weeks?
I think that they're probably as confused as most of us, trying to figure out, are these lasting? I think they're looking at inflation expectations. Is that starting to tick up? That would really begin to worry them. For now, that's not actually happening. So I think they're trying to...
Important distinction. Can I jump in?
Sure.
Market-based inflation expectations, the things that you can tell the world about in just a second, perhaps that's true. Survey-based expectations of the consumer, you, Mitch, etc., they have started to climb, and they've started to climb dramatically. We've seen this Federal Reserve respond to that in the past. Why won't they now?
Well, what you're saying is people aren't stupid. They realize with tariffs coming along that businesses are going to pass some of that on to them. They're going to pay higher prices, and they're going to adjust their consumption because of that. I think the Fed is in a tough spot, because while they see that, I think genuinely that inflation could be transitory. It could be there for a year, and then it could pass. They've already used transitory. They can't use that again. I think what they're more concerned about is how businesses respond to a drop in consumption. And if they start to pull back, then they've got to respond and cut rates.
I guess what John's trying to get at, to some degree, is which data are they looking at, the soft data or the hard data? Are they looking at the sort of more rapidly moving sentiment indicators from not just UMich, but others, as well as company guidance like Delta? Or are they looking at the figures that are released by the government at very periodic levels?
Well, they tipped their hand a while ago that they're looking at both. When the data, the hard data itself was pretty stable, we looked at their forecasts, and they had already started to adjust them. And he admitted that there are some members of the FOMC that were already thinking about how policy would interact with the economy. So I think it's a good Fed. I think they're looking at both. As I said, it's an impossible decision. The tension in the room is going to be very high.
The 10-year yield, if we see some lessening of nominal GDP, does the 10-year yield lead nominal GDP down, or does it follow nominal GDP down?
I think it will lead. I think that there will be a flight to quality in the Treasury market.
Where's your level on that? Where's your signal point, your trigger point, where the level of the 10-year yield where that touches?
I think we could go through 4% to 3.90 in a material slowdown where the market starts to begin worried about unemployment rising.
That's great, John. You can get into that 8,000 square feet you're looking at.
You think rates are going to come down that much, TK? I need rates at rock bottom. I need like 1% interest rates again. That's not going to get it done.
Yeah, mortgage rates just rose again for the first time in about a month, but whatever. Bob, I do want to ask, though, about that 10-year yield, how dependent it's going to be on any kind of discussion of quantitative tightening and potentially pausing it or starting to slow the amount of treasuries that it's letting roll off its balance sheet.
So let me just say, I hope the Fed doesn't change rates this year. I hope the 10-year stays where it is. I like yields where they are. That can bring in a lot of investors to the bond market. I'm a bond guy. Come on in. But you've got the Treasury Secretary out there saying that they're targeting the 10-year. And certainly pausing quantitative tightening is one way to do that. And then I think what you're also going to see is reinvestment of mortgage roll-off into the Treasury market. So those kinds of tools will keep the 10-year at least stable where it is and likely push it down a little bit. And although I expect them to say pause, we don't believe that they're actually going to pause. We think they're done.
Lisa, you're right to bring up QT. We spoke to a range of guests this morning on the program about that. Very, very split about what we might see in the next hour.
Yeah, Gennady Goldberg coming out and saying he doesn't think that they're going to pause quantitative tightening until at least September. Meanwhile, Aditya Bhave is coming up with Bank of America, thinks that they're going to announce it in some capacity. Deutsche Bank's Matt Lazzetti, I think, is sympathetic with that view. So a real sense that that might be the big news from this press conference.
That decision is 18 minutes away. Bob Michael at JP Morgan Asset Management will be sticking with us. Just a flavour of the bond market for you this afternoon. Bond yields are higher by 3 basis points at the moment on a 10-year, around 4.32. At the front end of the curve, up 4 or 5 basis points, reapproaching 4.1%. Coming up in just a moment, we'll catch up with Bank of America's Aditya Bhave in just a second, alongside Kathy Jones of Charles Schwab. Live from New York City this afternoon. Good afternoon.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
In case you missed it, on Bloomberg Surveillance, Elon Musk, who's leading Doge, was talking about maybe going to Fort Knox to make sure those gold reserves are there. Do you have any plans to visit Kentucky?
I don't have any plans. I can tell you that we do an audit every year. I can tell the American people on camera right now, all the gold is there. Any U.S. senator who wants to come and visit it can arrange a visit through our office.
Don't miss Bloomberg Surveillance, live every weekday.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The Fed, like so many others, are navigating a regime change.
They've been pretty clear that they're on hold here.
We're going to stay on hold for a little while.
The Fed isn't in a position to cut just yet.
I think they'll probably wait and see.
I don't think that they want to surprise the market hawkishly here.
They can no longer maintain that we don't speculate, we don't guess on policies.
The hard data and tariff information are really, we think, going to overshadow anything we'll get from the Fed.
They have got to take a view.
People are looking for the Fed to sort of come to the rescue.
That Fed put is something we won't see.
The Trump and FOMC puts, if they exist, I think are much further out. We've gone from huge confidence in a Trump put and a Fed put to questioning both.
That's been the big change over the last several months or so since the Federal Reserve last met. Your decision is 15 minutes away, and going into it, your equity market looks like this on the S&P 500. Equities here just a little bit firmer, but you know the story over the last 2 months. Since the Fed last met, this stock market is lower by about 6%. In the bond market, 2-year, 10-year, 30-year, your scores look like this at the moment. Over the previous few weeks, just glued to 430. Really tight trading range. On a 10-year at the moment, 431.57. Where you have seen a major change, though, so far this year is in the FX market. To see euro-dollar getting closer and closer to 110 in a year, when only a few months ago we were talking about parity, Lisa, all over again.
And it comes at a time where people suddenly are looking at a seismic shift in German politics, where suddenly they are embracing fiscal spending. And that has completely changed the game at the same time that people keep going to gold as a potential diversifier, up 10%.
You read my script notes over here. That's right where I wanted to go. On the show, folks, I've got to quote London Bullion Market Association. Gold or Pharaoh won't talk to me. But the answer is London gold is a moonshot, up 19% from the November bottom.
Who would have thought we'd be putting gold on planes coming to New York from London? And that would be an economic story. Who saw that coming?
No, you're doing that from Bulgaria, right?
All I can say is I feel bad for people's backs who have to actually hoist those suitcases up. Do you know how that would be terrible?
Like Van Cleef or Bulgaria. Which do you think?
All right,
TK's got experience. He's the only one around this table with experience of carrying gold bars into London Heathrow.
I can see that.
Joining us now is Kathy Jones of Charles Schwab, Bob Michael of JP Morgan Asset Management still with us. Kathy, welcome to the program. Decision just around the corner. What are you and the team focused on going into this one?
Well, I think we'll be looking very closely at the dot plot. I don't expect the median estimates to change, but there is some risk that given the rise in inflation expectations we've seen in some of the data, that those numbers shift up. And that would be a big shock if we went from expecting 2 rate cuts this year to just 1. So that's something I'm keeping an eye on. I don't think it's a high probability, but, you know, inflation expectations is something that Fed's really focused on. And when you look at the surveys, not just the consumer surveys, but the things coming out of the various regional Fed banks, you're seeing a lot of concern about tariffs, price pressures, growth pressures at the same time. And I think the Fed takes those surveys very seriously. So I'm a little concerned that we get this kind of stagflationary signal from the Fed that the market's not really prepared for.
Kathy, the Fed has a couple prongs that they could pull today. One of them is indicating how many rate cuts they're expecting on average, potentially, with assuming and suggesting among Fed members later this year. And then there's quantitative tightening. There's a balance sheet that has come down substantially from the all-time high, allowing them to roll off the maturing debt and not reinvest it. If they stop allowing that debt to roll off their balance sheet, would that be more supportive to markets than anything they could do with the front end of the yield curve?
You know, I don't think so. I mean, when we look at quantitative tightening, we don't really see a good correlation with movement in the market. And I think it's a bit more technical than that when they consider ending QT. So it does free up some liquidity at the banks. I'm sure a lot of people will take some excitement from that or view that as a bullish sign. But I really don't think that outside of freeing up a little bit of liquidity with the debt ceiling hanging over us, that's really going to be a big signal for the market.
Kathy Jones, 10-year real yield, 2.00%. Nice, convenient number. What does that signal to you, and where will it be 6 months, 12 months out?
Well, I think it signals it is a pretty good. You know, you 2% real yield. That's pretty pretty much narrow long-term historical average. It might be a little bit lower than it was in previous decades, but for this market, 2% real yield's pretty attractive. And I don't know that it's going to change a whole lot going forward. I would think it might come in a little bit if we get sort of expectations on inflation down. But by and large, I think 2% to 2.5% is a pretty good spot for real yields to be at the longer end of the curve.
If the Fed, Kathy, puts out projections that do have stagflationary type tendencies or trends baked within them, what does a Fed put look like going forward?
I think, if we believe in a Fed put, I'm not sure I believe in a Fed put, but if we believe in a Fed put, it really has to be more about if we run into an economic problem that the Fed has to act to counter. And so I don't know that there's a signal that we would see in this kind of a meeting, because we're not into an economic downturn of such magnitude that they have to do something. Yeah, the stock market's down from the highs, but it's clearly still pretty high. And the economy, although it is slowing and we see some softness underneath the surface, it's not collapsing. There's no crisis at the moment that the Fed needs to address with a Fed put. So I think they would really like to reserve that for some sort of crisis situation or a very serious situation that weakness, say, in the financial markets would somehow transfer into the real economy. But at this moment in time, it doesn't seem that bailing out a market at this level makes much sense for the Fed.
Let's build on this conversation and bring in Aditya Bave of Bank of America. Aditya, welcome to the program. Was reading your research over the past week or so on this Fed decision. You said the Powell put is not forthcoming. You're anticipating a stagflationary mix in some of the forecasts they unveiled in about 9 minutes' time. Let's talk about those forecasts together, Aditya. So in the SEP last time around, the 2025 GDP forecast was 2.1%, unemployment rate at about 4.3, PCE, core PCE 2.5, and a median dot plot basically signaling maybe 2 cuts for 2025. What do you think about all of that ultimately changes in the next 10 minutes or so?
Good afternoon. Thanks for having me. So we expect growth to be marked down a little bit to 1.8%. I think they can do that without getting particularly political, because they can just say, look, this is just a reflection of the expected weakness in first quarter GDP, right? And then on the inflation side, equally, just as a reflection of the last 2 months of data, which really have been quite disappointing without any tariff impact, we think they can go up to about 2.7% on the core PCE. We don't expect the dots to change, so they stay frozen at 2 cuts for this year. But if you really want to see what they're thinking, why they don't want to tell you what they're thinking, look at the distribution of risks. We think the distribution of risks at the back of the SEP will show a meaningful shift towards weaker activity and higher inflation.
Which raises a question of how they can respond to this. This is the nightmare of central bankers around the world. Stagflationary-like kinds of trends. How do they message that they want to support an ongoing recovery while countering some of these trends, while remaining non-political?
Right, so here's our framework for this. We understand that stagflation pulls their 2 mandates in opposite directions. So then you have to ask, where do you have buffer? We think you have buffer on the activity side of the economy with the labor market close to full employment, with growth well above trend, and financial markets at least starting this period of weakness from all-time highs in equities, right? Whereas on the inflation side, you don't have any buffer because you're already above trend. That's why we think that it's going to be very difficult for them to cut unless there are quite significant risks of a recession, which we don't see. And that's why we don't have them cutting any further.
Well, Michael, I'm going back and forth here between the dots in my bracket, and I'm really having trouble here. I mean, both of them are a complete fiction. How do you construct dots right now? I don't know how you do it in a normal time. How do you construct a Fed estimate of dots here, or is it like picking the bracket?
Well, I think they've told us they believe that the neutral Fed funds rate is much lower than where they currently are, so their bias is to look for an opportunity to bring rates down. I think Aditya is right. I disagree with them all year. They may not cut rates, but I think over the next couple quarters, they're not going to have an opportunity to cut rates. But they're going to bring them down. We're going to see that in the dots.
Is the dispersion going to widen today? To me, that would be the shock. I just don't see that. But is it the spread of the dots today?
Yeah, I think it has to. I think there will be those who are hawkish that will be concerned about inflation, and there will be those who are dovish that will be concerned about rising unemployment, and that's the opposite pole that Aditya talked about.
Just gauging how market participants, TK, feel about this over the last couple of weeks or so. The hawkish risk here, and I'm sure, Bob, you might agree, the hawkish risk here going into this meeting is that you downgrade your growth outlook. You have to push the unemployment rate up for the next year or so, and the median dot stays the same and still signals 2 cuts. That would be a hawkish development, and that's the risk for this Federal Reserve. They do nothing, they try to do nothing, the rest of the world changes around them, and doing nothing, the meaning of that changes. Is that the hawkish risk going into this one?
I'm not so sure that's entirely hawkish. I think the market is more or less expecting that. I think if they bring down rate cuts to 1 dot, to 1 cut, that would be particularly hawkish. That would worry me. And then I would be concerned that they're actually not expecting inflation to be temporary. They're not looking through it. They're concerned that it will be entrenched at these levels.
On the flip side, Aditya, I'd love your thought on this. If they are somewhat dovish and they do feel like, or they give the sentiment that they are more concerned about weakening growth than inflation, does that lead to a massive sell-off in the long end of the yield curve?
I think that's going to be very positive for risk. So let's start with that. And, you know, on the long end, it's mixed because it also depends on what happens with QT and so on. But that I think would be a very, very encouraging thing for risk assets, although nothing that they've told us to date suggests that they're going to go in that direction, right? I mean, all they've told us is we don't know what's going to happen, and essentially, therefore, we are frozen where we are.
Well, Bob, you're nodding, but I wonder, at a certain point, we talked about how after they cut by 50 basis points, we saw a huge rise in 10-year yields, and people said, oh, they made a policy error. Well, why wouldn't this sort of fear of doing that again prevent them from taking a more dovish tilt, at least in the near term?
Because I think back then the market was very excited that they would be on a path to 3%. And then you started to see how the election was going to evolve. You saw the policies coming out of that. And people quickly reversed, we're going to 3% to, you know what, we'll probably stay in the 4 somewhere. And that got priced into the market, and the Treasury market adjusted to that. I think it was that simple. I think actually the Treasury market's in pretty good tune with the Fed. The Fed's in pretty good tune with the data. The question is, what will the data be 3 to 6 months from now? The sentiment, or will it all have changed yet again?
My head hurts with the dots discussion. Kathy Jones, save me here. With the unusualness of the moment, what do you do with a portfolio duration or maturity? How do you nudge that? Which way do you move?
We're pretty much hugging the benchmark. So for us, the benchmark is the ag. It's around 6 years. You get a 460, 465 yield on that, all investment grade, high quality. I think it's a pretty good baseline. If you're a risk taker, maybe use a pop in yields to extend duration a bit, because we do see the economy slowing down in the second half. But, we're not ready to do that. And we're saying up in credit quality because we are seeing a deterioration under the surface in some of the weaker credits. So we're just kind of hugging the benchmark and waiting to see what happens.
Hey, Kathy, appreciate your time this afternoon. As always, Kathy Jones of Charles Schwab alongside Aditya Bharve of Bank of America. That decision 2 minutes away. Bob Michael, just a final word going into that decision.
What I heard from Kathy is they're buying bonds because, like us, they're seeing net inflows to the bond market. So you can be neutral. You're still buying bonds. I like the bond market here. We're buyers on backup in yields and credit spreads.
I imagine you're not alone saying that. Is there this wall of money that people talk about? Sounds a little cliche, but is there a wall of money waiting for any backup in bond yields?
Yes. All kinds of pools of investors are under-allocated to public fixed income.
Seen a massive sentiment shift to Europe and other parts of the bond market, haven't we, in the past year or so? This one's a big one. this really is a big decision. This is a tough decision, not because they're going to move 25, 50 basis points. It's not about that this time around. It's about how you navigate these policy changes, this effort to push a global realignment driven out of Washington, D.C. You've got to try and gauge the response of other actors, China, Europe. You've got to understand what it means for markets, consumer expectations, how that's going to translate into things like inflation, growth over the next several months, and somehow put out projections for the world to interrogate.
Which people will have to understand is something of a dartboard, throwing darts at it. Some of the questions, and I wrote down a whole host of them that I have for Fed Chair Jay Powell today. One of them is, are you more worried about stagflation-like conditions today than you were on January 29th? And if so, why? What has changed? And see how that gets navigated.
I look at their dual mandate quickly here, John. The dual mandate, it's all about labor, and it's moved the second derivative of some of those theories. Bernanke would say there's a lot of hockey sticks out there.
And is there a stagflationary mix in these forecasts? Remember, this is a three-part act. In about 10 seconds' time, you get two parts. You get a decision and the forecast. 30 minutes later, you will have a news conference with Chairman Powell. The equity market going into this one firmer by 0.4% on the S&P 500. With the decision, here's Mike McKee.
Well, I was wrong. We do have some news today. No change in rates, but a significant cut in the Fed's view of growth over the next 2 years. A majority of the committee moving lower on the dot plot, even though there's still 2 cuts forecast for next year. There's a pause in QT and a dissent on that. The benchmark rate stays the same, 4.25% to 4.5%, but the policymakers cut their median GDP forecast for this year to 1.7% from 2.1%, and next year to 1.8% from 2%. Headline PCE inflation rises to 2.7% this year from 2.5%, and core to 2.8% from 2.5%. The unemployment median for this year is now 4.4%, up 1/10. In their statement, officials removed language that risks to the employment and inflation mandates are roughly in balance, now saying the committee is attentive to the risks on both sides of its dual mandate. They emphasize that by saying uncertainty around the economic outlook has increased. That's reflected in the dot plot. 8 members now see 1 cut or 2 cuts or fewer. The median stays at 2 cuts with 2 more for 2026. The Fed, beginning in April, will slow its balance sheet runoff to $5 billion a month from $25 billion for treasuries. It will retain the $35 billion cap on mortgage redemptions. They don't attribute the change to anything, not to the debt ceiling, but we would expect Chair Powell to talk about that in his news conference. But the change in the runoff drew a dissent from Governor Chris Waller, who approved of the no change in policy rates, but dissented on the idea of slowing the balance sheet runoff.
Mike McKee, there's so much to work through here. Appreciate your time, sir. Apparently, stagflation is bullish. We'll get to that in a moment. We are firmer in the stock market by 0.6% on the S&P. On the Nasdaq, we're up by 0.8%. Mike went through the forecasts and the revisions. Let's do that again, because these are significant changes. Let's focus on 2025 and look at the median projection. The change in real GDP. The projection now, 1.7%, down from 2.1% previously, those forecasts made back in December. Unemployment up to 4.4%. The previous forecast was 4.3%. Core PCE, 2.8%. The previous projection, 2.5%. And the median dot, unchanged. So, Lisa, what we've got here is the Federal Reserve essentially saying inflation is going to be higher than we thought it would be. Growth is going to be weaker than we thought it would be. And as for policy, well, policy doesn't change. That is the stagflationary mix in the forecast that some people were anticipating.
Because we've heard it from all across Wall Street. If they hadn't done this, that would be sort of surprising, since they seem to be reflecting a general sentiment out there. Key question. How are they going to explain why? What has changed? Given the fact that, yes, we've gotten data that has come down, but we haven't necessarily seen a big spike up in inflation. And depending on what inflation expectations you've seen, you haven't necessarily seen them go up that much either. I do think it's interesting about quantitative tightening. I do think it's interesting about Fed Waller dissenting. And I'd like to hear a whole lot more. I also think it's interesting you're not seeing a huge reaction from the 10-year yield on that.
He's running. Talked about that a few
course,
times. We'll come back to that later if you don't know what we're talking about. Jim Bianco has thoughts, I'm sure. He joins us in just a second. Let's turn to the bond market. Bond yields were higher going into this decision. They are now just about unchanged, around 430. So we haven't broken out that range, that very tight trading range over the past few weeks on a 10-year maturity. The 2-year at 4.03%. There's a lot of conflicting stories, a lot of cross-currents to this decision here, Lisa. You've got stagflationary mix in the forecast. The median dot remains the same, implies 2 cuts for 2025. And then you're slowing down the balance sheet runoff at the same time. This is going to be a really tough news conference to navigate for Chairman Powell. With those forecasts, it gets harder.
Especially because he's not giving any explanation as to why they are pausing quantitative tightening. He has to explain why they are changing their forecast and why they haven't changed how many times they expect to cut rates. How do they balance these two risks at a time where, again, stagflationary-like scenarios are the worst-case scenario for a central bank?
Buried in the headlines is a single one. FOMC median this year unemployment projection rises to 4.4%. The moment that overshoots, the dialogue changes. I don't know, with all of our esteemed guests, John, I'll let you decide. Is 4.5 a trigger point? Is 4.7? To me, it's a round number, 5%. But I'm sorry, 4.4% is emotionally, for President Trump, a long way from where we are right now.
Tom, I think we have to be really patient about how we process and internalise what the Federal Reserve is telling us this afternoon. I often say when we get a Fed decision or economic data, these are the market moves, let's see if they stick. These are the market moves. We'll see if they stick. I don't think the market moves right now should shape the narrative too much. Just take a step back. Don't even look at the market. The Federal Reserve is telling you that they've had to dial back growth expectations, but that won't lead to lower interest rates. The Federal Reserve is telling you that on the margin, unemployment's going to be a little bit higher. But relative to what we thought back in December, that doesn't mean additional interest rate cuts. On the surface, looking at that alone, and I know there's a lot more going on here, that's a hawkish decision from the Federal Reserve.
On the margins, this is them saying that they need to prioritize inflation just as much as unemployment rising to 4.4%. And that right now, the market's grappling with at a time where inflation is as much of a risk to asset prices as is potentially downward growth.
I'm looking, John, a message just in from Drew Mattis of MetLife. He's getting closer to being a net buyer of treasuries again. I told him to call Bob Michael.
Bob Michael's with us now from JP Morgan Asset Management. Bob, we gave you some time to go over this one. What are your thoughts?
This is a dovish Fed. When I look at how they changed their expectations, they lowered GDP by more than they raised inflation. That's tip number one. You look at unemployment, they're worried about how businesses will respond. So they raised unemployment. That's tip number two. And then they said, I believe, uncertainty around economic activity increases. Think if you're in corporate America and you hear that, what do? You stop spending and you hold all the capital you can. This is a very dovish Fed.
Put your interest rates where your mouth is, not you, Chairman Powell. Why have they kept the median dot unchanged? What's that about? If they are that dovish, if you're downgrading growth, shouldn't you back that up with a lower median dot?
Well, I think that they're comfortable with the 2 dots where they are. It's 2 more rate cuts. I'll take it.
Jim Bianco of Bianco Research can get in on the conversation. Jim, I'd love your thoughts on this situation. We talked about it, lots of cross currents, lots to process. Where do you stand on what we've just heard?
Yeah, I agree with a lot of what Bob was saying about that nominal GDP came down. In other words, they cut the real growth more than they raised the inflation rate. But I think ultimately, I've termed this the meeting before the meeting. I think the most important meeting for the Fed is going to be the May 7th meeting. All right, they cut their forecast. We've got the histrionics of a 10% correction. We're all talking about tariffs. If we get to that May 7th meeting and they do not find a reason to cut rates, they're not going to find a reason to cut rates this year unless something else comes that we don't expect. And I think when you look at the market right now, at least the initial reaction in Fed Fund futures and the like, is that they're not going to cut rates at that May 7th meeting. So we'll have to see what transpires in the press conference that kind of gets us going there. Because like I want to emphasize it again, what more would they need to see at May 7th that they already haven't if they go to that meeting and they don't cut it? So this is the meeting before the meeting.
There's also a question about just how much inflation expectations are going to tick up and what the signal is from them pausing the quantitative tightening program. Jim, it's in the weeds. We've heard from Kathy Jones that's just a technical adjustment. It's not going to make that big of a difference. Does it represent something more to you?
Yeah, only in the extent that a lot of the quantitative tightening, the rolling off of the balance sheet was that they weren't buying mortgages to the extent that they used to. And that has become a bit of a political football for the Fed. In the era of high mortgage rates, they seem to be backing off and trying to support lower mortgage rates. Well, now they're trying to do that by, so I think that there is going to be, some issues with that, and there's going to be some discussion about why they did it. And I hope he's asked, and I'd like to hear a good explanation for why, because obviously it wasn't a unanimous decision. Fed Governor Waller dissented from it.
Jim Bianco, to give you a victory lap on the last time the White Sox won 3 games in a row, you nailed transitory inflation. You nailed the stickiness of it. If we get inflation to come in with this low growth estimate, how will the Fed respond to that?
I'm afraid, that it's going to be more like what we saw in September. That when the Fed, I'm in the camp that when the Fed cut rates by 50 basis points in September, the bond market looked at it and said, look, you're not serious about inflation, so we're not serious about the bond market, and yields went up. I know we try to blame Trump and the Trump policies and that, but it turned right on that Fed meeting when Harris was leading in the polls and interest rates started to go up. So it was more about the Fed meeting and them being aggressive. So if they're going to respond to the idea that the economy is slowing, but inflation is staying sticky by cutting rates or threatening to cut rates, they run the risk of the same reaction again. You want to produce 5% in the 10-year rate? Well, then, cut rates when the market is still worried about inflation. And I'll remind everybody, we've had 46 straight months now of core inflation above 3%. And the Fed keeps talking about their target being below 2. We can't get core inflation below 3, let alone get to their target of 2%. And if they start cutting rates again, they run a very big risk of a bad reaction.
Jim, how does an explosion of fiscal spending in places like Germany and China complicate the story when suddenly there's a lot more competition around the world for the dollars or the currency to fund people's deficits?
Well, I think the first thing you'd have to look at is, the example that we had with the CARES Act in 2020 with an explosion of fiscal spending was inflation. And I think you're probably going to see an uptick of inflation in Europe, and that's going to reverberate through everywhere. Remember, when we had our uptick of inflation, so did they. I suspect if they have an uptick of inflation, it will come back to us, not $1 for dollar, but we'll see an upward push of an inflation. And I also think that that's also going to attract capital to Europe. They've got, they got down to like a 10 PE on a lot of their stock markets where we were above 20. So they're a cheap market, and now they're stimulating. And they're willing, and at least equity investors will be willing to tolerate more inflation, but bond investors won't. So I think you'll start to see higher, you'll see those higher rates in Europe continue, and maybe higher inflation rates, and that will come back and be more problematic for the Fed if they want to cut rates later on this year.
Hey, Jim, appreciate your time. As always, buddy, Jim Bianco there of Bianco Research. Miami Keys runs the news conference. You'll see him ask a few questions, I hope, in about 20 minutes' time. He writes in, look closely at the dot plot. 8 members now see 1 cut or fewer. That's up from 4. Only 2 now see 3 or more. That's down from 5. It won't take much to move the median in the other direction. This is where I'm struggling with this decision. I feel lonely around this table. I see stagflationary adjustments in the forecasts. I see a Federal Reserve that's not accompanied a downgrade to growth, with an upgrade to the amount of cuts we'll get this year. In fact, quite the opposite. And they're telling you things are really uncertain right now. So it's not obvious to them how they would respond to adverse shocks in the economy. That's a change for this Federal Reserve. Typically, it goes something like this. Growth's bad, we can respond. We're not constrained because inflation's going to be lower. That's not what they're forecasting right now. Now, this can all change in the news conference. Maybe Chairman Powell could explain this in 15 minutes' time. But I just sit here and I just say, look, if I didn't see the market, I'd be sitting here thinking that was a very hawkish mix from the Federal Reserve. I know I'm very lonely. Jim disagrees, Bob disagrees, but that's what I see right now.
You're not so lonely. There is a shift in the mentality around the Fed right now, which is that disinflationary process is squarely on its trajectory downward, is no longer valid. That has been a shift, and they can no longer count on that to allow them to just unabashedly respond to downside growth shocks. And that is what you're seeing reflected in those dots. And on the margins, that's hawkish, because they're not going to necessarily come to the rescue in that way. That said, do people believe these dots, et cetera? And, that's another story. So that's, I think, where maybe people are leaning some of their confidence.
Bob, is stagflation bullish risk assets?
No, it's not. It's a pernicious ingredient into risk assets. So
what can you take away from the fact that this is a stagflationary mix to the adjustments of the forecast from the Federal Reserve? And they seem to be very uncertain about what to do with policy. When was the last time they were in this position?
It's an expected stagflationary environment,
Fair point.
We're not in it now. And I think when you talk to a lot of corporate management, you'll find that they're pretty guarded and sanguine about what they're doing. So I do worry that if what we expect to happen actually happens, then the response from
Dan
corporate
Swonk
America will
of KPMG is going to jump in on the conversation. Bob's going to stick with us. The news conference starts in about 16 minutes' time. Dan, you've had 14 minutes to pore over all of this. What jumps out for you?
I actually am on your side of the equation here. I think this was much more hawkish, and the Fed not quite going to one rate cut, but the number of people who are expecting one rate or less cut this year going up. That gives you that sense of the dispersion of risk and the challenge of corralling the cats in a very uncertain environment. We've seen several Fed presidents come out and evoke the 1970s as a cautionary tale. This is a stagflationary forecast, not a horrible one, a very mild bout, but the uncertainty factor is really true. I think what you're going to see Chair Powell do is separate the balance sheet issue, because excess reserves are starting to get to that point that they really need to slow down quantitative tightening so they don't have a hiccup and some kind of seizure in the Treasury bond market. They don't want a repeat of that September 2019 event, and that's what they're hedging against. They still want to run off their mortgage portfolio. They don't want to hold mortgage bonds. Their mortgage bonds, they're going to roll off when people buy those homes because nobody wants those right now. They're not just going to easily roll off in a very stagnant and stuck housing market. But I see this as a much more hawkish kind of tone from the Fed. Also important to note, the ingredients that go into the PCE, which the Fed has already calculated between 0.3 and 0.4%, an acceleration, not the cooler numbers we got in the CPI and the PPI. It's going to be 2.8% core PCE next Friday for the month of February. That's an uptick in inflation, both on a month-to-month basis and year-over-year basis. They know that. They've made that calculation as well.
Diane, across Wall Street, a lot of people have downgraded growth expectations and upgraded inflation expectations, talking about the policy mix in Washington, D.C. How does the Fed address this without getting political?
Well, that's why you're seeing so much uncertainty, and they just say, we're not going to front-run any policies. This, unfortunately, leaves them in this data-dependent mode, and we don't know what the decision rules are on what kind of unemployment and what kind of inflation number are going to make them pull the trigger in one direction or the other or stand hold. They'd rather stop short on rate cuts and wait for policy and to see how that plays out through the economy. That's going to be a very pregnant pause. I don't think there's any chance that they cut in May. I think that's a very low probability. We do not have a cut this year until early 2026 because of the underlying upward pressure on tariffs. Now, much we'll find out, more information on that on April 2nd. And then, of course, it matters in terms of how it actually plays out. The Fed does not want to front run this. I think that's the most important message that Jay Powell is going to try to point out, that he's only going to react to whatever happens in the economy that keeps him out of the political fray.
Diane, we talked to a lot of people in fancy zip codes who tell us things are slowing down, whether it's Morgan Stanley or UBS today. What do you see where you are, from Aurora over to Gary, up to Waukegan? I mean, within the Goolsby district, what are you actually seeing in labor dynamics?
We are seeing some slowdown. I spend a lot of time talking to a lot of small businesses in the area as well. And one of the things we're really starting to see is things like that pullback in restaurant spending that we saw in retail sales, this sort of hesitancy, builders complaining that people aren't walking through, doing the, seeing the kind of looking for houses that they had seen out there before, not seeing the foot traffic they once did. Those are things that are important because that sort of reflective of some of the consumer confidence numbers. Now, we've also seen a lot of front running of tariffs, and every company I know out there is trying to hedge their tariff situation. That's already pushed up costs of many things even before the tariffs that we have currently went into effect, and they're now having to deal with that as well. And that's a very challenging environment. There is a real chill, of course, in terms of what is the carve out for USMCA, and many companies that technically qualify for USMCA and the carve-out that they hope to get in the auto industry on April 2nd, they did not apply for the permission on that because there just wasn't a reason to before, and now they have to be certified. So this scramble in terms of, I'll tell you, our tax and customs group, and I'm working with them constantly, and logistics are absolutely slammed right now.
Diane, there was a time when Tom and me got in trouble for calling an ECB news conference a snooze fest. We're not going to get in trouble this time around because this won't be a snooze fest. This is gripping stuff, Diane. I just wonder from your perspective what you would ask Chairman Powell as that news conference begins in 10, 11 minutes' time.
I think the most important thing to ask, because he's not going to be able to tell you what the actual reaction function is, but we know they're doing scenarios. He talks about scenarios. We need to sort of push him on what are the scenarios that the Fed's looking at right now, and what does that mean for policy?
John, Ian Lingan, publishing at Bank of Montreal, BMO, he supports John Farrow's view. The distribution of projections shifted hawkishly.
Look, the fact we're having a debate about it means that Chairman Powell needs to address something in about 10 minutes' time. Dan Swank says it's hawkish of KPMG. Dan, appreciate your time as always. Bob Michael of JP Morgan Asset Management says it's dovish. Now, maybe we can explain this by saying that there are different seats here. One is an economist, just talking about things as they see them. Another is a market participant saying, well, this is what was priced and this is what was expected in financial markets. And maybe you can make that argument this afternoon. But I do think if you take the market out of it, Lisa, if I just looked at those forecasts, if you told me they'd be downgrading growth expectations and maintaining interest rates, in fact implying that maybe it'll be 2 cuts or less, not 2 cuts or more, based on where the median dot and the distribution of dots was last time around, I think we'd all agree that that was a touch hawkish.
I think the vocabulary has changed. And frankly, this scenario is gotten away from the vocabulary that we used to use in a very different time. If you're talking about stagflationary-like environments, suddenly the definition of hawkish and dovish takes on a very different approach.
The rules have changed. Matt Lazzetti joins us now of Deutsche Bank. Matt, welcome to the programme. We've got a split decision here. You're going to be the break-in vote. Matt, where do you go? Is this dovish or hawkish this afternoon? What is this?
I would love to be the two-handed economist at this point, just telling you it's either hawkish or dovish. I think, given the downgrade to growth, and the increase in the unemployment rate, the fact that you saw an upward shift in the dots is kind of clearly a hawkish signal. At the same time, the fact that the Fed is telling you that they are cutting rates at median expectation 2 times this year, with core PC inflation that's 80 basis points above their target and growth that's essentially around potential, kind of continues to signal that there's a dovish bias there. So I think there's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated. I think there was a fear of a median of 1 rate cut for today, and so far at least that fear was alleviated.
Matt, you expected them to pause their quantitative tightening, this idea of allowing their balance sheet to shrink. Does this actually mean anything other than just a technical adjustment to smooth the gears of Wall Street?
No, I think for the Fed, this is clearly a technical decision. They slowed rather than paused. But again, I think that was kind of a technical decision about how they were going to deal with MBS and the fact that they might have to buy in the secondary market. And so really, this is just the Fed telling the market they're going to be very cautious in dealing with the balance sheet. They don't want to repeat the mistakes of September 2019. And they're going to be just cautious in dealing with how things evolve here.
I'm going to go to strategist John Farrow on this. You can't make this up. Out on Twitter, Ed, thank you so much for this for John Farrow. My 16-year-old son has saved $500 and wants to invest it. Should he wait till after the press conference? What do you think?
That is the trillion-dollar question. Matt Lazzetti, how do you think the chairman will approach this news conference in 8 minutes' time?
Look, I think he should just be repeating how he's been discussing in the outlook, which is there's a lot of uncertainty at this point in time. They still think the economy and labor market are solid. They're in a wait-and-see approach here, and they're in no hurry to adjust rates. And I think by the May meeting, by the June meeting, they're going to have greater clarity on how some of these policies are working out. They're also going to have greater clarity on the fallout from the big spike in uncertainty that we've had over the past month. So by May or June, I think we should be hopefully in a reduced uncertainty environment with greater clarity about what the policy outlook is.
Matt Lazzetti of Deutsche Bank. Matt, one of the best. Appreciate it, sir. That news conference is about 7 or 8 minutes away. Whatever you think about the decision, you've got to reflect how the market has responded to it. There's always a signal, some information there. And right now, the equity market is firmer off the back of the decision, Lisa. We are firmer by 0.8% on the S&P.
Because they maybe caused quantitative tightening, maybe because they still signaled 2 rate cuts. All I know is on the margins, the bond market is sort of slowly getting around to the same kind of dovish response to this meeting. Again, hard to say what that means, especially given the fact that this news conference is going to be the most important part of this whole 3-part act.
Bob Michael, you've seen a million of these in the past. What's unique about this news conference with Chairman Powell that's just about to start?
I've been watching a couple things. For the last month, we've watched gold go up and flows into short-duration government bond funds, which told us investors were looking for the safest anchor in the storm. While we're seeing equities drift higher today, maybe it's a little bit of relief, we're seeing the same response. Investors are trying to counterbalance that. Gold has turned up. It's about up $5 an ounce. It was down, and money's gone into the Treasury market. This defines the conundrum in markets. It feels good right now, but there's an expectation things are going to get a hell of a lot worse when broader tariffs hit. Yeah. How is the Fed going to deal with that?
John, importantly, not only is gold is up to record highs.
All-time highs, through 3K.
Which has raised this question about what's going on. Is there this larger question about assets moving away from the United States? I just wonder, you say it feels good now. Does this feel good? Does this sort of projection feel good for anybody? I mean, what do you do with this? How come risk assets seems to still be looking for a Fed put at a time where the Fed is telling us we have no clue what to do?
I think everyone's relieved that the Fed didn't jump to significant conclusions, that you're not seeing 0 or 1 rate cut. And I know there's a change in the balance, that they didn't raise inflation expectations to over 3%. I think we'll look further into the statement. I think investors took comfort from that this is going to be a balanced and stable Fed. They know about as much as we do, and who knows what's going to happen over the next couple months.
Is Fed policy still in a good place?
It's in a great place. It really is. I think it's a miracle. They got us to 4% unemployment, 4% wage growth, 2-ish% GDP, 2.5% inflation from where they were, and now they've been dealt a real problem with a global trade war, which is a stagflationary economy killer.
So I'm going to ask the question slightly differently then, but it's the same one. Is the Federal Reserve in a good place? For any central banker facing downside risk to growth and upside risk to inflation, it's not a good place, is it?
No, I told you, mark your calendar for 2031. That's when the tape of this meeting will be released. It's fascinating. The tension in the room must have been through the roof.
Lisa, regime change. Totally different place for this Federal Reserve to be in compared to where they before. And I remember earlier this week you talked about the contrast between now and the pandemic. And you made the point that in the pandemic, it was easier for the Federal Reserve because they knew what to do. Just respond with lower rates and buy everything. This time around, it's difficult to know how to respond to these kind of shocks.
And frankly, there still is a lot of disagreement about whether some of these tariffs are disinflationary ultimately down the pike. Right now, they have to not overreact at a time where they are very worried about unemployment rates going up because they know how scarring that can be for an economy and the sort of long lags that can hold.
I would point out that whatever anybody's politics, at any time you pick up your cell phone and you look at names 6, 7, 8 newspapers, including Bloomberg News, people are shocked, John, at the cacophony of headlines. I think the Fed is part of that discussion. They have to be incredibly ex post until they see those headlines work out, political headlines.
It's one of those meetings, Tom, where you can sort of create a narrative out of everything here, hawkish or dovish. I do think it's material and something we haven't talked about just yet. If you look at the forecast for core PCE, yes, they had to revise that higher for this year, but I think it's notable. You really start to gauge how the Federal Reserve feels about if there is an inflation shock, how long-lasting it will be. Now, I don't expect them to use the T word later on in this news conference, but it's implied in the forecast. They're looking for 2.8% in 2025. relative to the previous projection of 2.5. But then you look at 26 and 27, unchanged at 2.2% and 2.0%. We're trying to tease out what they really think about policy without them telling us what they really think about policy. And I think that's one way of doing it.
So let's translate this. What this means is that there's initial adjustment up in prices with the tariffs, with some of the other trade tensions, with slower growth coming down the pike that limits demand because the supply is not going to be somewhat constrained or more expensive. And then you get disinflation because they have to ultimately lower their prices. This is what they're trying to gauge out. What their role in this is a lot less clear.
Is that another way of saying transitory in those forecasts, Bob?
John, you know what's amazing? We're 2 months into an administration that's creating this volatility. The Fed and we have 3 years and 10 more months of this to go. Think about that.
And they've still got to wait for April 2nd. The big changes come at the start of April.
So this is really something they have to deal with. How do they signal steady, calm, predictable hand at a time when everybody's heads are spinning and they cannot react too quickly? That is going to be a difficult thing to message, given the fact that a lot of people are saying this has to do with policy changes that haven't been firmed up, that are still negotiations more than just pure policy.
We're beyond the world where you can provide forward guidance. So we're not expecting sort of clear clarity on any forward guidance, but this is the kind of world where you need to clearly establish the reaction function. How will you as a committee respond to certain scenarios? That's what we want to hear in this news conference, I think, and that's what we want to see from the chairman when that news conference begins in about 60 seconds' time.
And what you're going to get is some people thought this, some people thought this. Chris Waller dissented because he might be or might not be in the running to be Fed chair. This is going to be a very difficult messaging act for Fed Chair Jay Powell, especially given the flipping and the flopping from December to January.
Governor Waller can speak for himself. I'm sure he's got other ambitions that maybe Chairman Powell doesn't want to talk about in this news conference. Bob, you're always fantastic about this. What would you ask the chairman in this news conference if you had a seat in that room right now? What would be top of mind?
I'd ask him what the Fed is watching to gauge inflation expectations.
What do you think they are watching? Because it doesn't seem to be the survey data. Or is it the survey data? Have they been spooked by that? Is it the hard data? Is it both?
I think it's a combination of both. And I think it's also going to do from their survey of small and mid-sized businesses, see what they're going to do with the price increases and see how much of those they'll push through.
How much weight they put on all of this will be incredibly important. The chairman of the Federal Reserve with a very challenging news conference. That news conference begins right now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer-run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So two things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it, a good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of a longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros of the Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation?
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature that has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs. So you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up, but prices also went up on dryers, which were not tariffed. So the manufacturers just kind of followed the crowd and raised it. So things happen very indirectly, and so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
pandemic? Yes, during the pandemic.
Because you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we also we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is from each of those two measures is from its goal. and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that.
Well, just to follow up, yesterday the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months, a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it. We don't dismiss data that we don't like. We force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer-run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There is a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that. And we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty. And we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. at that point. We'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth, and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah. So in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June. Was it June? Whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, what speed. There's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer-term or medium-term inflation expectations are moving.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
I'll do a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. You know, sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, you know, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. Or sorry, no, beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, you know, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. You know, the real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, you know, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but, you know, we don't want to get ahead of that. You know, we want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, you know, higher levels to pretty close to 2%. While the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, you know, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. You know, underlying inflation is you know, still running in the 2s with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
You know, it's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France-Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens it will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. It slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I'd just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
He can't wait to get out of there. Chairman Powell, fascinating news conference, the most interesting news conference we've seen with the Fed chair in quite a while. Let's start with the price action. A big portion of uncertainty with a sprinkle of transitory. Equity markets rocketing. We're up by 1.5% on the S&P 500. On the NASDAQ, up by 1.9. On the Russell, up by close to 2. In the bond market, 2-year, 10-year, 30-year yields down hard at the front end of the curve by 5 basis points to 398. Check out the commodity market. Gold, all-time highs. Intraday up by about 1/3 of 1%. There's a couple of interpretations here. Here's one. It's the bad news. So they've downgraded the outlook for growth, but haven't responded by projecting additional cuts. Here's the good news, and this is what the market seems to be leaning on just a little bit more. And the Fed chair spoke to it. Based on the forecast, the Fed believes that any upward revision to inflation in 2025 won't last beyond 2025, into 26, into 27. On that and more, take a listen to what the Fed chair had to say.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
A willingness to look through this, perhaps reinforced by this take on you, Mitch. Michigan inflation expectations reading is an outlier.
Okay, going back, there's a lot to unpack here. We can talk about Michigan and how much that actually did or did not inform them back in 2022 and why it's less relevant now. The point about transitory is a key one. This market is looking through the downward revision to growth of stagflationary-like circumstances that frankly defy logic for why that should be good for risk assets and point squarely to this belief that the Fed has resurrected transitory and is going to cut rates in the face of weakness.
Yeah, what I find fascinating is, John, you mentioned it correctly, to see gold go out to a record high 2/3 of the way through the press conference. Folks, I've never said that. And the technical destruction of the equity markets to see the Dow and the S&P pop the way they are, by no means do they have some buoyancy of a buy signal. I mean, there's some damage out there from the politics folding into what he has to deal with.
The market reaction carries a lot of weight, and right now this equity market is rallying going into the closing bell about 40 minutes from now. Joining us on the programme to react, the former New York Fed President, Bill Dudley. Bill, three-part act, we've wrapped it up. We've had the forecast, the decision, and now the news conference. What's your reaction to all of the above?
Well, I thought the summary of economic projections was actually a bit hawkish in the sense that they downgraded growth and pushed up inflation. And the dot plots, the dot plot did sort of shift up. They didn't shift up enough to change it from 2 to 1 rate cut this year, but it did shift up. Powell then came in and I think gave a pretty dovish performance in the sense that, we got this. We're in a good place. We can afford to wait. We'll see how it goes. We're going to get the job done. So he, I think, was pretty reassuring to people that this was all, quite manageable. I think the reality is, the growth outlook is worse, the inflation outlook is worse, and uncertainty is a lot higher. I'm not really sure how you parse that out as positive, but Powell put a pretty dovish spin on it.
Bill, that's where transitory comes in. It was resurrected, the word that was once left for dead, thought to look through some of the tariff-induced inflation, saying it probably would subside. What do you make of that? Because it's giving a lot of confidence to this market.
Well, one thing that he did talk about was inflation expectations, and he basically said, look, there's only one indicator that's really shown a significant increase in long-term inflation expectations. Everything else looks fine. So he's basically telling people you can ignore the University of Michigan long-term inflation expectations measure, which has shot up very sharply the last month or so. So that's reassuring. So I think people think Fed's got this. I think the reality is they're flying blind. They don't really know what's going to happen to growth. They don't know what's going to happen to inflation. And that increases the risk of making a policy mistake or just being late.
There's a book years ago, Bill Dudley, with a chapter by Bill Dudley and Ed McKelvey, and you said off of Patrick O'Brien, there's not a moment to lose. How exposed is this Fed? They're, to me, not a moment to lose. They are wait. Isn't that their best outcome?
Well, I don't fault them for waiting. I think when uncertainty is really high and and the economy is in a pretty good place. Inflation rate's running 2.5%, 3%. The unemployment rate's around 4%. Staying here, indefinitely would not be a really bad outcome. So I think that's what gives them the ability to wait because the starting point is actually pretty good. The other thing I thought was interesting about Powell's remarks is he sort of minimized the soft data that's showing a lot of weakness and said we're really sort of focusing on the hard data. We haven't seen weakness in the hard data yet. So that was also reassuring.
This is what Marko Kolanovic, formerly of JP Morgan, has to say out on X this afternoon. Not in a hurry means we will drag our feet when things get worse, like in the fall of 2018. This is not bullish at all. Bill, you've lived a lot of this in the past. Is there a risk of a repeat of 2018 here?
Well, I just think there's a risk that the Fed will be late because if you have to have the information in hand before you act, and there's long and variable lags of monetary policy, then you're not going to do the necessary action in a timely way. I think that the same, but at the same time, which way does the Fed lean? Do they lean against the inflation or do they lean against the growth side? I thought it was interesting the summary of economic projections also didn't get a lot of attention, but people's assessment of uncertainty about inflation and employment both went up. Their assessment of risk to inflation and employment both went up. And I think that's really what tells you what's bad about the economic outlook now is that this dispersion of possible outcomes is pretty wide, and we just don't know which way we're heading.
Bill, you said that this is a Fed that's flying blind, and essentially Fed Chair Jay Powell said as much when he was asked why there was this ongoing 2 rate cuts priced into a market where you had some pretty sizable changes to growth and inflation. And he said, what would you write down? It's really hard to know how this is going to work out. Is there any time in history, Bill, that you can think of where the Fed was as flying blind as they are right now?
Well, I'm sure there have been other times. For example, when you had the 2 oil price shocks in the 1970s, that wasn't very good. You had the great financial crisis in 2007, 2008. Lehman Brothers failed over the weekend, and then the Fed was meeting the next Tuesday and Wednesday. So that was probably a pretty flying blind moment. So I think there's been other times like this. The good news is that your economy, as Chair Powell made it clear, is starting from a pretty good place. And that's the important part.
John Farrow, David Rosenberg, just out on Twitter right now, really has, and this is the insight that I had with Bob and Michael before, a 4.4% unemployment is a single stick, 100 basis points above the 3.4% low. You got to go back to 1948 to see that abruptness without a recession.
So we had some deterioration last summer, Tom. I'm with you, but it turned out to be a head fake.
Yes,
and the Federal Reserve was somewhat unnerved by it going into Jackson Hole and signalled some reaction to it, Lisa, and they followed up with 100 basis points of interest rate reductions, and here we are again. And we're trying to figure out if the soft data and the deterioration we've seen in the survey data is a head fake or not, and whether it will translate into softer hard data down the road.
And it seemed like this was a Fed more willing to say maybe it is a head fake with respect to the soft data and not necessarily emphasizing it as much as, say, the hard data, at the same time reducing their forecast. I wonder if we're making too much of the dots. I wonder if we're making too much of all of these utterances when essentially you have a Fed chair himself saying, we have no clue.
We don't know.
We don't know. Inertia, we kept it the same because what are we supposed to do? And so there is this element where you have to look at this and say, on a fundamental level, is monetary policy still in the driver's seat at this point? Or is this a fiscal policy-driven market and, frankly, an economically driven market that the Fed cannot really engage with in a constructive way?
So, Lisa, in moments like this, I wouldn't put too much weight on the forecast because the chairman is telling you we don't know. I'd put a lot of weight on the communicated reaction function, how they're communicating, how we'd respond to certain information points. And, Bill, I wonder what we've learned today. If we did get a deterioration in the economic data over the next several months, in the hard data, have we learned that this Fed would respond to that? Or would this Fed wait? Because I think that's critical for a lot of investors. Are they constrained? Is the easing bias now constrained by the inflation uncertainty of the next 12 months?
It's definitely constrained to a degree. I think the thing to focus on is the unemployment rate. If the unemployment rate stays where it is, then the Fed can wait. If the unemployment rate goes up to, say, 4.5%, then the Fed has to worry about the whole thing giving way. So I think the tightness of the labor market, how the labor market is performing, is really important. And that itself has a lot of uncertainty because, remember, the growth rate of the labor force this year is going to be much, much slower than it was in 2023 or 2024 because very little in-migration, deportations, so big slowdown in the labor force growth. So what that means is you can have slower growth and not have much change in the unemployment rate. So I think the unemployment rate is the summary statistic that I'd be focusing on.
I agree with that, Dr. Dudley. And my question is a 4.4, 4.5% U3 unemployment rate, is that the same as a U3 unemployment rate of 10 or 20 or 30 years ago?
No, I mean, I think the unemployment rate consistent with full employment has come down over time. Part of that's due to the aging of the population. Older workers are employed at a higher percentage of the time. So I think, the Fed's view is that we're basically at full employment right now, 4% or so. But if we go up to 4.5%, the Fed's going to be starting to worry that this whole thing is unwinding in a bad way. And then they'll, be really assessing, is if inflation bad news, transitory, or is it getting into inflation expectations?
It's difficult to say with that in mind, Bill, that this Federal Reserve is in a good place. Do you think it's in a good place?
Well, they're in a good place in the sense that the economy, the starting point for the economy is in a good place. They're not in a good place in the sense that they're being hit with shocks that are bad for growth and bad for inflation, and they don't really know what the policy is going to be yet. So I think they're not in good shape in the sense that, let's put it this way, they like where their car is sitting today, but they now have to drive down the road in a very big, foggy environment.
Hey, Bill, thanks for helping make sense of it. Appreciate it. Bill Dudley there, the former New York Fed president. Lisa, after a conversation like that, you wouldn't have guessed that the equity market is up by 1.2% on the S&P.
I don't understand in any way why a stagflationary environment would be positive for risk assets. I think that was sort of what Bill Dudley had to say as well. You raised a point, though. If this is a Fed that still is going back to the transitory idea and believes as their base case that these tariffs are going to have a one-time inflation ramification, but that will die down, then why wouldn't they be more inclined to cut rates in the face of weakness? And that goes to this dovish aspect that's being reflected in markets.
Mike McKee joins us now. He's run out of the news conference to catch up with us. Michael McKee, the T word, makes a comeback in the news conference. What was your reaction?
Well, it did cause my eyebrows to go up a little bit, and I wondered if he had been warned against that. But seriously, you guys had the smart people on ahead of me, Bill Dudley and Lisa Abramowitz. I agree with both of the things that they said. Bill Dudley said this Fed is lost, and I think that is the case. They don't have any idea what's going on in the economy. And as Lisa said, you really can't believe or take seriously anything that they projected today because they don't know. This stuff has a half-life of the next tweet. So at this point, the Fed is just trying to reassure the country, which probably explains what we're seeing in the markets today, is that Jay Powell sounded like he was reassuring, but I wouldn't take any message out of this. Everything that he said after good afternoon, I would sort of put to the side.
What did you make, Mike, of his complete dismissal of the University of Michigan sentiment survey?
Well, that's a kind of standard thing for Fed officials, the old we watch what they do, not what they say. And people have the inflation numbers in these surveys have been distorted a lot in the past because people don't really have a good handle on what the inflation rate is. They just know their grocery prices are going up. So I can understand why he said that. And it was just a 1-month move in the longer run. The shorter run has moved up for a couple of months. So I think this is maybe a little whistling past the graveyard in terms of not trying to give the impression that the Fed is worried and going to have to take some action.
Mike McKee, appreciate the updates, sir. Looking forward to your coverage throughout today and into the weekend as well. Lots to process here. Equities up nicely by 1.2% on the S&P 500. That bounce continues. With us around the table to close things out, Amanda Lynham of BlackRock. Amanda, where to begin? It's a lot to process here. One thing we haven't talked about enough, and Lisa mentioned it coming into the decision, a reduction in QT. How important is that to this market?
Well, good afternoon. Thank you for having me. Two things jump out to me. One is going back to the growth inflation mix being more challenging. A lot of this was baked in heading into this expectation. And so I think that's part of why we're seeing the market reaction. We've had just such a bruising few weeks in the equity market. Most forecasters have reflected a lower growth and higher inflation. And I think that's part of what's driving this here. And I would just underscore something that Bill Dudley said, which is I think this just makes the growth backdrop all the more critical because the Fed is telling you that inflation will not allow them to be responsive. And so really that 1.7% growth in the SEP, slightly below trend, that really has to hold up for risk assets to validate this move because the Fed's telling you that they can't respond. As it relates to QT, I think maybe that's why you're seeing some modest relief in longer end yields in the bond market. I think on the margin that could be somewhat helpful versus the counterfactual, but I don't think it's the main driver. I think the main driver here is that a lot of this bad news was baked in heading into this expectation. A more challenging growth inflation mix is the base case, and I think it warrants some widening in credit spreads.
Do you think it's positive that he resurrected the transitory word?
I think it was accompanied with a healthy dose of we're not quite sure what's going on.
Was absolutely everything,
I think the market is kind of looking through that. But from my perspective, his kind of reinforcing that the labor market is still in a solid place is to me the key thing. Because if you think what's driving the resilient growth that we've seen over the past few quarters in the U.S., it's the consumer in aggregate. If we have a higher layoff rate, so if corporates start to be concerned about margins, they flex that layoff tool more aggressively, which is still quite low. That's a situation where that weakness that's so far confined to the low-end consumer could extend more broadly. So what to watch? Micro-level commentary, high-frequency data on the labor market, capital markets functioning, right? Like the idea that corporates can issue just at a higher cost, that's fine for market functioning. I think where the Fed starts to get concerned is if the markets are frozen.
There's also this question of the long end of the yield curve and why it should go down if this Fed is biased to looking through any inflationary shock as simply near term, if that is their base case, and we will not know for a longer period of time. Does that raise concerns about longer term entrenched inflation, especially at a time of global fiscal releveraging?
Absolutely. And I think our base case is that longer end yields are structurally higher, right? So that's the view across a variety of platforms at BlackRock. And I think Right now, what we're seeing is that treasuries are not a reliable hedge in risk asset underperformance. And so what you've seen to a certain extent, treasuries can rally when there are growth concerns, but it kind of peters out at a certain point. And really, for rates to rally significantly, you actually need to have more valid recessionary-like concerns. You can't just have a growth slowdown. So what we're seeing is that it's almost like a quasi-hedge, but it's not a firm hedge. As for the inflation expectations, I do think it is concerning that they're not expecting inflation to get back to target until 2027. Similar message from the ECB, frankly, where President Lagarde said it's going to be a further path. When you think about the spillovers of German fiscal spending, right, higher bond yields, these markets don't operate in a vacuum, right? So equities versus credit or Europe versus US. And so I think we are bracing for structurally higher rates and structurally higher inflation.
If we have 1.7%, and if we get the x-axis wrong and it extends, that tells me Republicans get tossed out of Congress, just as one talking point. And there'll be huge pressure. Does it just devolve down to price up, yield down, and we go through 4%, as Bob Michael told us before the conference?
I think so. I mean, I think you asked earlier the unemployment rate that's really problematic for consumer credit. 5% is the metric that we're hearing that things really become problematic. But I think on the way to that journey, so when you start to get to 4.5%, I think you start to get concerning. It's the velocity of that move, and often these are nonlinear, right? So the deterioration happens quickly, as we've seen in prior cycles. I think that is very concerning. But to me, it really just hinges on, Chair Powell mentioned a low hiring, low firing environment. If that firing picks up, that's really problematic.
That's exactly where I wanted to go. Tomorrow morning, 8:30 Eastern Time, jobless claims drop. Help me understand the scenario. If we start to see some weakness there, how will markets respond to that? How will we think about the Federal Reserve's response to it?
I think markets have front-loaded it a bit. You've seen some widening in credit spreads. European credit is still holding in well, so I think that points to the U.S. concern. From my perspective, the Fed, though, is somewhat constrained in how they can respond to that given the inflation backdrop. So I think that's why the deterioration in the growth backdrop is so important to monitor, and it's also probably more critical than it was even a few months ago. Because a few months ago, the expectation was inflation will continue to cooperate. If further progress on inflation is delayed, then you somewhat have one hand tied behind your back in terms of I guess the question is, how much of a growth deterioration needs to occur before the Fed can react? And it seems to be that the bar is pretty high for that.
That's another way of saying bad news is bad news. If it is bad news over the next few weeks.
Especially when accompanied with even near-term inflation. I'm just struggling to understand what kind of offset they can provide by cutting rates at a time where inflation is a concern. I just keep going back to that. And this question about how supportive that will actually be. I guess that if the news is bad enough and they cut rates, it'll still be bad, but you also might get a little cheaper borrowing costs.
This goes to the wait and see. Confidence was a word that came up in that news conference. How long before you have any confidence? I'm not sure anyone can have any confidence right now. How long do they have to wait before they see?
Well, that's what I think makes the high-frequency data so valuable. And as we saw during the pandemic, it was the company commentary that actually shined the light on how pervasive the supply chain disruptions are. I think this just underscores the point. You have to be invested for a wide range of growth, inflation, and policy outcomes. All right, so it's not even just the growth inflation mix, it's the policy mix. So incorporating floating rate exposures, real assets, inflation hedges, those are all things that are really valuable, because I think there are just so many paths on this probability tree that we really have to position for all scenarios.
When we were coming into 2025, there was this belief that we have on one hand a Fed put and on the other hand a Trump put. Trump put still out there as sort of a question mark. The Fed put, people are saying, well, maybe they're going to be willing to step in. Can we really frame the issue in that kind of way? I guess that's sort of the fundamental question of today, where the market's treating a dovish response from the Fed as being positive for risk assets. Is that the new paradigm? Is it the old paradigm?
Yeah, the one thing that jumped out to me from Chair Powell's comments, previously he had talked about that they would respond to an unexpected weakening in the labor market. If the now base case is 4.4% unemployment, then it seems to me like you'd actually have to have something beyond 4.4% unemployment to step in and respond to that. So I guess it's saying that the bar is actually high, because right now they're telling you that they're expecting some weakness in the labor market beyond that.
Unlike the three of us, you went to class on Friday at Villanova years ago. We remember this well. When you study stagflation or hints of stagflation, there's a point where every central bank has to choose price change, finance, or jobs, jobs, jobs. I see no indication of anything, but they're going to capitulate to a higher unemployment rate down the road and ignore the rate markets. Is that the way you read it?
I mean, I think that's what their forecasts are telling you, is that they're baking in some deterioration. And so what does that mean for risk assets? A stagflationary environment is unquestionably negative for risk assets because in that scenario, you have a bit of a double whammy of wider spreads and higher rates.
We don't do logs this late. We've all been up since 5 a.m. or 4 a.m. But the answer is it's nonlinear, is it? That's really what we're talking about. I think that's right. And that wasn't in the press conference.
I think that's right. And I think when you take a step back, yes, we've had some widening in credit spreads, but all things considered, we're still really tight. And so we're baking in an expectation for an ongoing rebuild of risk premia. So I think the market is rallying today because this was not as hawkish as it could have been. I think the risk coming into this was maybe we just saw one cut in 2025. We kept the two. But going forward, I think we should be baking in some widening in credit spreads. And we would view that as an opportunity. And I heard your conversation with Bob earlier. There is a lot of demand on the sidelines. So I think being opportunistic is really the key to take advantage.
You're seeing the same thing? How much appetite is there for fixed income?
We are. And I think I would say save for the lowest quality pockets of the market where, for example, CCC interest coverage is still below 1 times. And so that's a very tenuous place. But foreign demand, yield-based demand, long duration spread product, high quality spread product, the U.S. is the largest, broadest market for that. And so there is a significant amount of demand. But I do think there needs to be a rebuild of risk premia, given this is unquestionably a more challenging growth inflation mix.
Where is that money coming from? Does it come at the expense of risk assets like stocks? And I speak at a time where Howard Marks of Oaktree came out and said he prefers credit right now over at equity risk because you are getting income and you have a greater degree of certainty.
And you're higher in the capital structure. And I think maybe one of the understated themes of the past few quarters or maybe past few years is that corporate bonds, because of the higher interest rate, are throwing off more cash just on an ongoing basis. And so just reinvesting that cash is something that's important. Foreign demand has been a big tailwind. I will say on the margin, we are bracing for some of the foreign demand for U.S. dollar credit to, over time, perhaps be repatriated back to European markets now that European yields are quite attractive. And so on the margin, that's something to watch for. But again, these risk assets don't happen in a vacuum. But I do think there's a significant amount of demand, whether it's coming from equities, it's coming maybe from different parts of foreign markets.
I mean, one thing we haven't talked about here, we got BlackRock on the desk here. I mean, John, it's just simple. BitDog, moonshot, out to 85,000. I mean, these are the indicators, and technically it's not telling me anything, but I'm sorry. You're going 78,000 to 85,000.
Gold signals something too. What are we seeing there from crypto, from gold?
I think that's diversification. I think that's the market saying that perhaps...
come on, it's fear.
I think the gold is perhaps central bank buying, some other dynamics going on there. But I think a big part of it is portfolio diversification, real assets, inflation hedges, uncorrelated exposures.
Oriental rugs?
The stagflationary backdrop that we suggested, the 60-40 portportfolio wouldn't fare that well in that sort of...
That sounds personal.
She's a machine. I love
that sounded personal. Who's been forcing you to buy rugs?
Look, I'm looking at this. I don't have any technical veracity on Bitcoin.
Wait, is that hold on a second, pause. Is that your Haven trade? Oriental rugs?
My Haven trade is tuition. Okay,
have we finally found out what's happened with the triple leverage cash fund? It's been going to rugs.
Oh my gosh.
I just upset BlackRock. I was in syndication with them. They wouldn't go for triple leveraged all cash.
Amanda, appreciate your time. Fantastic. What a moment. Amanda Lynham there of BlackRock. Perhaps we're being fast and loose with the S word, stagflation. We're looking for growth close to 2% and inflation anywhere between 2.5%, 3%. But it's the mix. And this is what Amanda was talking about, the mix here. This is the challenge the Federal Reserve is facing. It is the central banker's dilemma. Typically, the kind of dilemma you see in emerging markets and not in developed markets. Downside risk to growth, upside risk to inflation, and a Federal Reserve uncertain, low on confidence, and not sure what to do.
And that's the reason why gold is really telling us something. And that is this real question about whether the United States, with the policy mix and the monetary policy backdrop and inflation where it's coming from, can avoid a stagflationary-like spiral, not necessarily stagflation of the 1970s, but an environment that makes it more difficult to repay a debt load that's causing a lot of concerns for a lot of people.
Peter Fisher taught me this. Get your hands out. He says, on radio it doesn't work. We're going to go with this. The answer is here on a nominal GDP basis. Today, the lower growth was balanced out by stagflation to a pretty much level nominal GDP. What happens to Amanda Lynham's call if we get nominal GDP to begin to compress? That's what's not in the discussion.
I'll tell you what this market's doing for the benefit of our TV audience, like this, up and to the right. just sort of up and to the right. That's the story today. We'll see if this holds. We are positive by 1.5% on the S&P 500 going into the closing bell. Coming up on the close, the team's going to take it over. They'll be catching up with the former Fed Governor, Betsy Ju. From New York City this afternoon, good afternoon to you all. Thank you for choosing Bloomberg. This was Bloomberg Surveillance.
In case you missed it on Bloomberg Surveillance, Elon Musk, who's leading Doge, was talking about maybe going to Fort Knox to make sure those gold reserves are there. Do you have any plans to visit Kentucky?
I don't have any plans. I can tell you that we do an audit every year. I can tell the American people on camera right now, all the gold is there. Any U.S. senator who wants to come and visit it can arrange a visit through our office.
Don't miss Bloomberg Surveillance, live every weekday.
I fell in love with cricket. I started reading about cricket. You know, cricket is not a very simple game to follow. You need to understand it. And here I didn't know a simple thing like there are different kinds of bowling. Like there is a spin bowling and there's a pace bowling, and in spin bowling there is a different kinds of off spin and a leg spin. And in pace there is a swing. And so it took me some time to just start talking to all these boys of cricket. I spoke to Sachin, who is known as a god of cricket, and I would ask him such embarrassing questions. But yeah, today it feels very good to see Mumbai Indians doing so well. My son is leading it. But also I think the Mumbai Indians women's team is something that fills my heart.
Why?
With joy. I think these girls go through so much to get to where they are. Right from seeking permission from their parents who are not willing to let them follow their dreams, financial issues. When you see them all coming together from these remotest villages of India and play for you and tell you these stories, it's just so inspirational to see our girls in sport.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. We're about 10 minutes away from the closing bell. And what a rally we have underway here. The S&P is up by 1.2%. Scarlett, this is the best